All right, we're now live. I'm just going to give it a moment while people join, and then we'll go ahead and get started. Just give it a minute. I see people filling in. All right, I'm sure people will continue joining over the next minute or so. Okay, we can go ahead and get started, and hopefully a couple people join in the next few minutes. So good afternoon, everyone, and welcome to our fourth quarter stock portfolios update of 2023. We'd like to thank you for taking the time to join us today to discuss what's been happening in the market, how our advisors are reacting, and our overall thoughts as we near the end of the year here. So we invite your questions. If you have any, please feel free to submit them for Steve in the Q&A box, and we will try our best to respond to them. As always, there's a lot to cover today. If you need anything at all, please feel free to chat us, and we will help you. And with that, I'd like to introduce you to Steve Galli, our Chief Investment Officer, to take it away.
Thank you, Katie, and thank you all for joining us this afternoon. I hope that if you are in our time zone, maybe you're having a yummy lunch while you listen to some of our commentary on the markets. Again, I'll try and make this informative and interesting and funny, maybe all at the same time. And if you have any questions, fire away, and we'll try to address all of those. And so with that, I will get into the presentation. So as everyone knows, usually we go through sort of some topics about what's happening in the markets out there. Then we discuss, sort of some more details about the investments. And then we discuss what we're doing with the portfolios. And at the end, we do always have time for Q&A. So a lot of interesting headlines. This year has been, I would say, a lot of unexpected developments this year, I guess, but you can also probably say that about every year. There's always unexpected developments, but this year has been especially tricky. A lot of what people thought was going to happen this year really didn't happen, and a lot of things happened that weren't expected. So I always pull down a few headlines from some of the major financial publications. This one's from Barron's. The house price market this year has really been interesting because despite the fact that we now have very high mortgage rates, basically mortgage rates are higher than they've been in over 2 decades, housing prices are stubbornly high. And a lot of that has to do with a lack of inventory. So that's been an interesting development in the housing markets. I think this is kind of another interesting headline from Barron's saying the earnings recession is over, but the economic recession is coming. Well, what does that mean? Well, really what they're getting at is that companies were expected to not have great earnings this year, but actually their earnings have been pretty good, but probably not good enough. And a lot of companies are talking about how they don't expect earnings to be as good next year, which might preclude a recession in our economy next year. So we'll talk a little bit more about that. This was a headline in the Wall Street Journal the other day about, is the stock market rally about to rev up? Because, after you've been looking at the markets, I mean, the last few weeks have been actually pretty good. So the question is that going to continue all the way through the end of the year? This is a recent headline from Bloomberg talking about how some of the biggest investment banks out there are disagreeing on whether the Federal Reserve is going to cut rates in the future. And a lot of that has to do with whether or not we have a recession, whether or not the Fed has to cut rates in response to a recession. So lots of different opinions about that. And here's another ominous one. Now, if you've listened to me speak about things before, you know that I always focus a lot on unemployment. Unemployment is the last domino to fall usually before we do have a recession. Unemployment has remained incredibly low for a long period of time, but there have been some signs that might be coming to an end. which is this is actually a headline from Bloomberg that I just pulled off today. So when we talk about this year, really what's happened this year. So if you look at this this chart here, what I've done is I've kind of sorted, I've sorted it by year-to-date returns. So this is telling us certain sectors of the market, how they have done. And, not surprisingly, this year, it's been all about tech, all about growth. So, for example, the NASDAQ 100, which is a technology-oriented index, that's up over 45% this year, an astounding return. And that's been led by those big tech companies, which we've been hearing a lot about in the press. And tech stocks are considered usually growth stocks. So growth stocks in general have also done really well this year, as evidenced by the S&P 500 Growth ETF, which is up almost 24% this year. And that's at the expense of what's the other type of stock? Value. Value has really not done much this year at all, as evidenced by the Russell 1000 Value Index. And that is one of the reasons why we always try to make sure that we are well diversified between growth and value. So you never know which style is going to be very much in favor at any given time. And then I also highlighted the fact that bonds this year have also done a whole lot of nothing. They are barely in positive territory, at least if you measure it by the U.S. Aggregate Bond Index. And if bonds actually end up negative this year, that would really be the first time in bond market history that we've had 3 straight years of bond market declines. Very rare. Although it looks like bonds may squeak out a little bit of a gain this year. So we will keep an eye on that. Now, one of the other things that's a dynamic that's happening in the market is that a lot of the market returns have been driven by a very small number of stocks. So if you take a look at the upper right quadrant of this chart, I think that's pretty interesting. The upper right chart is telling us the percentage, the weight of the top 10 stocks in the S&P. And as of a few days ago, the top 10 stocks in the S&P 500, which is really just 2% of the stocks in the market, right, are an incredible 1/3 of the entire market capitalization of that index. So only 10 stocks account for over 1/3 of the market cap. That is dangerous. That means that the market returns are very concentrated, very narrow. The rest of the S&P 500 stocks have not done that well this year. So I point this out because if you look at this next chart, I think this is really interesting. This is showing the return of the S&P 500 equal weighted index versus the S&P 500, which is normally and always a market cap weighted index. Well, what does that mean? Well, a market cap weighted index means that a company, for example, like Microsoft in the S&P 500 has a large percentage of that index because its market capitalization is huge, just like Apple. Apple is the largest company in the world measured by market cap. Therefore, Apple is the biggest member of the S&P 500. An equal weighted index assumes that all 500 members of the S&P have an equal percentage in the S&P. So in other words, instead of Apple being upwards of, let's say, 7, 8, 9% of the S&P, in the equal weighted index, it would be the same percentage as every other company in the S&P. And if you think about it, that would mean that basically Apple would only have I think, let's see if I do my math right, a 1/5 of 1% weighting in the S&P 500. So The reason this is interesting is because if you look at the last 5 market concentration peaks, and we are at a market concentration peak right now, this is telling us what happens in terms of the equal weighted returns versus the market cap weighted returns. And in every case, when we have had markets where a very small number of stocks have accounted for a very large percentage of the overall market, their returns have not been as good as the rest of the market at large, right? So this is telling us that in the next 1-year period, the next 2-year period, and the next 3-year period, in terms of market returns, it's better to diversify into some of those companies that aren't as large. And that's been the case every time we've had these heavy market concentrations. So I point this out because this is one thing that we focus on a lot with our portfolios. We make sure that we have most of our portfolio picks basically equal weighted, right? We're not trying to guess which stock we should have more percentage in versus another. We think it's more important to make sure that they're well diversified and all our holdings are equal weighted. And I think this chart makes that strategy a lot. It points out that makes a lot of sense, especially given the fact that we have such heavy concentration right now. So what are some of the other things that are happening out there that I think can benefit the market moving forward? Well, one thing is that investors have a lot of money on the sidelines, or a lot of money in short-term money market instruments, cash, CD, or treasury bills. So as you can see here in the cutout, U.S. investors have over $10 trillion in short-term cash equivalents. That is really high. That's a lot of firepower if some of those investors decide, you know what, I think I want to put more of that money to work in investments that probably will return more over the long term, which usually means stocks. So I think that's pretty important because that usually means that even if we do have a downdraft in the markets, there is a lot of money waiting to be invested into the market. There's a lot of money waiting to buy if things get cheaper. We'll talk more about that in a minute. Now, this chart may look busy, but it is actually one of my favorite charts. So this actually shows the S&P going back over 40 years, all the way back to 1980. And what it basically tells us is it shows the dark bars show us the actual return of the S&P every year. So for example, in 1980, the S&P returned 26%. That's despite the fact that during the year, at one point, the S&P dropped as much as 17%. So the red dots are showing during the year how much the S&P actually dropped. But as you can see, in most cases, even though in certain years the S&P might have dropped a lot, it usually came back, right? So I think if we're looking at this right here, this negative 34% drop marked the crash of 1987 when the market had a massive meltdown. But guess what? The market actually ended up that year by 2%. So I think the point here is that, yes, the markets can be volatile. They can move up and down a lot. But in most cases, the S&P ends up positive. And very rarely do we ever have consecutive annual declines. The only time we've had more than 1 year, the only time we've ever had 3 years of straight declines was after the dot-com bubble burst in 2000. But other than that, the S&P has never had more than 1 down year, 2 down years consecutive. And I think that's important. And of course, here we are right now. The S&P is up about 17% year to date. And that's despite the fact that, as many of you probably experienced, the S&P already dropped by over 10% this year at one point. But it has already come roaring back and is now up 17% this year. That's why a lot of times we counsel people, be patient, ride out the waves, because usually you're rewarded in the long term. Okay, now, same chart. Now, this is for bonds, okay? So bonds, of course, are not as volatile. So you won't see double-digit declines, except, of course, 2 years ago, which was the first double-digit decline we had in the bond market since 1976. Very rare. We also had actually, that was last year in 2022. We also had a down year in the bond market in 2021. And as I was saying, if we actually have a negative year this year, that would be the first time the bond market ever dropped 3 straight years. Incredibly rare. And as a matter of fact, in most cases, the bond market never drops by more than 1 year. Usually the next year it recovers. But as you can see, we are not having a wonderful year this year in bonds, but I do think that presents opportunities to invest in bonds. Because why? Well, bonds have been beaten up for 3 years. What does that mean? It means that bonds are more reasonably priced right now. Bonds are cheap relative to their history. Therefore, we have been buying a lot of bonds for clients. Clients have been pretty happy with the bonds we've been buying. And I think they will be very happy with those bonds moving forward, because I'm almost pretty sure that we're not going to see another down year in bonds, certainly not next year. So that's really important to talk about, and it's an important thing to think about for portfolio diversification. Now, many of you always know I always talk about international stock and why it's really important to have a good component of your equity allocation allocated to international stocks. What is this chart showing us? This chart shows us that US stocks versus international stocks usually go in cycles. Now, for anyone who has been talking about how important it is to be in international stocks, well, if you have been saying that for the last 15 years, you've been wrong. And why is that? Well, that's because US stocks have generally outperformed international stocks basically since the great financial crisis of 2006-07, all the way up until last year. Now, this year, believe it or not, international stocks have slightly been outperforming US stocks, and that's represented by this little blip here. So the question is, are we getting ready for a new cycle to replace the massive cycle we've just seen where US stocks have outperformed international stocks by more than 14 years straight, and by cumulative outperformance of over 275%? I don't know, but since these things tend to go in cycles, I do think that speaks to the fact that it's very important to maintain diversification and not put all your eggs in the US basket. I do think international stocks are cheap relative to US stocks. And as everyone knows, I always like to buy things on sale. I really don't like to buy things when they're not on sale. Okay, so now that we've talked about a lot of different important macro factors, let's just look at the market in general here. As everyone knows, I love to look at this chart. This is a way of kind of assessing, is the market expensive or not? So this is about a year ago. At the beginning of November a year ago, stocks weren't really expensive. They were kind of trading right along their long-term 25-year average with a forward PE ratio of about 16 and a half. Meaning for every dollar of earnings for the S&P 500, you had to pay about $16.50 for that dollar. Not expensive, not cheap, not necessarily a bad time to invest. But where are we now? Well, now we are well above that long-term average. As a matter of fact, we are now over 18 and a half times earnings on a forward PE basis. Things are more expensive. And why is that? Well, this year has been pretty good. This year, we've seen the markets go up by double digits, certainly in terms of the S&P, certainly in terms of growth and tech. And therefore, things are more expensive. Things are not on sale right now. That is one of the reasons why we do think caution might be in order. Now, they're not super expensive. They only get really super expensive when they cross this dotted line here, which represents 1 standard deviation away from the long-term average. But they're definitely not cheap. And as I mentioned, there is a big diversion here in terms of value versus growth. growth stocks tend to be those, when you buy a growth stock, you're not buying it because it pays a nice dividend. Most growth stocks don't have much of a dividend. You're buying it because you expect the share price to go up. And why would the share price go up? Because the company's growing, because it's increasing its market share, because it's grabbing more and more clients that generate more and more revenue. Unlike a value stock, value stocks tend to already have a pretty established market. They tend to really have a consistent cash flow type of business. They tend to have reasonable margins, and that's why they pay nice dividends. You're not buying value stocks necessarily for that growth story. You're buying it because it's a solid business that kicks off steady cash flow. But those types of companies have not been in favor this year. The market has favored growth. The market has favored tech. And why is that? Well, because right now the market is really in love with the artificial intelligence story. Artificial intelligence is mainly a big component of a lot of technology companies, which tend to be those growthy type companies. But that means that value stocks have been ignored a bit by the market, and it means that they're much cheaper relative to growth stocks. So that's one thing to keep in mind. It's one thing that we're looking at, because again, not a bad time to buy things when they're on sale or cheap, and possibly take some gains from those growth stocks that have already had a really nice run this year. Okay. Now, not to be ignored, this is actually what the US Treasury yield curve looks like. What's the yield curve? It basically shows on the x-axis the time to maturity, everywhere from 1 month to 30 years. And on the y-axis, we see the yield. And in this case, it's anywhere from 4.6% all the way up to 5.6%. And as you can see, the yield curve is still inverted. Inverted meaning if you buy a 10-year Treasury bond, you're getting about 4.6%. If you buy a 2-year, you're getting over 5%. That means the bond market thinks the Treasury curve will get back to normal. And if it does, well, what does that mean? Well, it probably means the 10-year is going to stay right where it is. So one good question is, well, when was the last time in the last few years, when was the 10-year at 4.6%? Well, let's see. Back in 2003, the 10-year was also right around 4.6%. But look at where all the other bonds maturities were. This is a normal sloping yield curve. And this is the way it's supposed to be, right? You should get paid more for taking more risk by owning longer term bonds. If you're going to loan your money for 10 years, well, that's a lot riskier than loaning your money for a year to the government. So back in 2003, which was basically 20 years ago, you were getting around 1.5% on a 1-year Treasury, and you were getting about 4.5% on a 10-year. If the yield curve normalizes to this in the future, that means that all these shorter term treasury, this is going to come down, right? So that's one of the reasons why we're spreading out clients' bond portfolios. We don't want to just take advantage of just the short-term securities, because eventually we won't be able to buy them at these yields anymore if the yield curve gets back to this normal slope. So let's take a look at some bond prices. This is one of my favorite things to do, is look at bonds all day. Right now, we're looking at 5-year maturity government bonds. And that means, so they're government bonds. So what does that mean? They're rated. They're rated AAA. It means basically their default risk is almost nothing. It's the government. The government can tax people if they ever run out of money. So technically the government is not at risk of defaulting. Therefore, they are generally rated AAA by the rating agencies. And as you can see, what's the yield we're getting if we buy a 5-year government bond? We are getting about 4.5%. Not bad for something that's risk-free. But why is it not necessarily always a good thing just to have government bonds? Well, because corporate bonds do yield more. And why do they yield more? Well, let's look at this. Corporate bonds yield more than government bonds because corporate bonds have a risk of doing what? Going out of business. They can default. Now, it's important to note that even if a company defaults, even if a corporate bond defaults, that doesn't mean that you lose your money, unlike a stock. If a company goes bankrupt and you own stock in that company, you're going to lose all your money. The stock is worthless. Not true when you own a bond of that company. So for example, let's say you own a corporate bond of John Deere, one of those wonderful manufacturing companies that make those iconic green farming equipment vehicles. If John Deere actually runs into trouble and defaults on their bonds, well, as a bondholder, you have first claim on the company's assets. Unlike a stockholder, you're last in line, you're getting nothing. But as a bondholder, even if John Deere defaults, well, you can, as a bondholder, get money back because John Deere will have to sell all their equipment, all their manufacturing facilities and factories. And by doing that and raising money by doing that, bondholders can recoup a lot of their investment. That is why bonds inherently are safer than stocks, because they have a claim to the company's assets. Why? You are loaning money to that company. That company is therefore indebted to you, and you are protected because you are a lender. Just like a bank lends you money for your mortgage, how are they protected? Well, they're protected by, they can take your house. So that is why bonds are safer, and that is why corporate bonds, by the way, yield more than government bonds, because there is a chance they can default. But as you can see here, this shows a 15 cumulative average default rate. Bonds have a very low chance of defaulting if they are, quote unquote, what is known as investment grade. What does investment grade mean? It means that they have ratings that are at least BBB or above. Now, anything below BBB, that has a much higher chance of default. That is known as high yield debt, or better known as junk bonds. And they can default much more often, and that is why they are more risky, and you have to be much more careful when you invest in high yield bonds. But that being said, high yield bonds actually have a very attractive risk return perspective in the long term, because you get paid for holding a high yield bond because of that extra default risk. So the yields on high yield bonds are a lot higher than yields on investment grade bonds. But for the most part, when we invest our clients' money in bonds, we are really only investing in investment grade bonds, because we do not want to have to experience a default. So let's take a look at the yields on corporate bonds that have an A+ rating or better. Those are pretty good quality bonds. So let's take a look. This is 5 years, same 5 years that we were looking at for the government, but these are corporates. So as you can see, I can buy a bond issued by Pfizer, a massive pharmaceutical conglomerate. And what am I getting? Almost 5.25%. Better than the government bond, right? Because there is some default risk. So I think that's really important to note, that you can get better yields from corporate bonds. What if they are A- or A? Well, here's another 5-year chart showing that I can get over 5.5%. Now, some of these are real estate related. This happens to be Ameriprise, but why would a real estate company be giving me almost 5.5% or over 5.5%? Well, that's because the bond market thinks that some real estate is under pressure because of the pressure on commercial real estate, because rates have come up. So the bond market knows that. So that's why the yields on those securities are higher. Now, what happens when we get in that lower investment grade range, or BBB+? Well, here, look at this, 6.8% from a Boston Properties bond. Why is that? Once again, the bond market's a little nervous about what's happening in the commercial real estate market. How about Citigroup? This is an A3 BBB+ bond. I think Citigroup's probably going to survive in the next 5 years and probably is not going to default, but I can get 5.77% on a 5-year Citigroup bond. That's pretty good. So we're very cautious and very careful when we pick bonds, but I just wanted to give everyone a perspective as to why we think it's important to take advantage of the corporate bond market, because I do think that it's pretty attractive when you can get, to some extent, close to equity-like returns from something that is a lot safer than a stock. Okay. As everyone knows, we tend to talk about some stocks that we do have high conviction in our portfolios. Many of you may have heard of Cisco Systems. Now, the irony of this is that Cisco actually came out with earnings yesterday. The earnings were actually good, but during the earnings call, Cisco talked about how they weren't expecting as good of earnings moving forward. And again, perhaps they're seeing signs of a recession, just like some economists are seeing potential signs of a recession. But the bottom line is the market didn't like that. So Cisco stock is actually being punished as we speak right now by the market because the market reacts instantaneously to new information. And the new information they just got is that maybe Cisco won't make as much money next year as they thought. That being said, we do think Cisco is a very solid investment. It is one of the few technology stocks that actually pays a pretty nice dividend, close to 3%. So even if Cisco stock doesn't go up, you're still getting that 3% dividend. We also think that Cisco stock is relatively cheap. This is actually a chart looking at Cisco, which is the bottom line, and the S&P 500, which is the top line. This is showing the 5-year cumulative return. So the S&P over the last 5 years has returned about 60%. Cisco only 13.5%. Cisco has lagged the market. It is cheap. It is relatively cheap versus the market. And I like buying things that are cheap. I like buying things that are on sale, especially when I think that the future could be brighter. And basically, I do think the future is brighter for Cisco because they are moving towards more of a cloud-based platform, which is very, very important for their business. And by the way, it's not just my opinion, but we also make sure that we're looking at a lot of other opinions. So this is actually a research report from Morningstar talking about Cisco Systems and quote unquote, Cisco remains poised for continued enterprise networking dominance. Great. We believe Cisco's portfolio is appropriately positioned to benefit from trends toward hybrid work and hybrid cloud environments. Sounds pretty good to me. As everyone knows, I love value line research. What does value line say? Well, first of all, Cisco is ranked safety 1. Now, as everyone knows, that's on a scale of 1 to 5, 1 being the safest. We always like safety 1 stocks from our value line research because we know that means they have very, very strong balance sheets, really, really good discipline in terms of debt versus equity. That's important. The timeliness on a scale of 1 to 5 is not bad. And the financial strength rating, according to Value Line, is an A++. I wish I always got A++ grades when I was in high school. So this is a pretty solid report from Value Line. Again, I do think that's one of the reasons why we like Cisco stock. And we also like it because it's very rare to have a technology-oriented stock that does pay a pretty good dividend. So, and by the way, part of the Value Line report, I was reading it the other day, and in quote unquote, it said the company hopes artificial intelligence, or the AI buzzword, will drive demand for Cisco products. And they recently launched new switching chips that are designed to efficiently handle the vast data traffic and networking requirements of graphic processing unit clusters, which is a foundational technology for many AI operations. What does that mean in English? It means that Cisco is basically designing their systems to make sure that it can handle the increased demand, the increased computing power demand that AI is going to require when companies are leveraging AI. So I think that positions Cisco really well. That is why it is in many of our core portfolios and why we think it's a good holding. And yes, it's unfortunate today that it's being beaten up a bit. We look at that as a buying opportunity for the long term. Okay, so just to sum up, we've just gone past about the 30-minute mark. I do think that it was really interesting that, this year everyone thought we were going to have a recession. Well, we didn't. Actually, we may have what I think is a mythical soft landing. It's kind of like a unicorn. We've never really had soft landings, but the Fed may actually pull it off, meaning the Fed may actually be able to reduce inflation. And by the way, we had good inflation numbers the other day, which means that they are being successful at that. And they may be able to do that without actually breaking the economy, throwing it into recession, and causing the unemployment rate to jump. So, and we haven't had a recession because our GDP growth this year in this country has actually been pretty good. That's been a surprise. But again, the inverted yield curve does not lie. It's like George Washington and the cherry tree. When the inverted yield curve inverts, it always predicts a recession. Now, we don't know when, right? It doesn't predict the timing. The timing can vary widely, but that inverted yield curve ultimately means we will have a recession. As if anyone remembers, if I was a betting man, I would probably say there's a 50% chance we have a recession in the second half of next year, maybe a 25% chance in the first half, and maybe a 25% chance that it happens in 2025. But we'll always be taking a close look at this, because why do we care about recessions? Well, that's because usually during recessions, stocks get beaten up. So we want to be, as well positioned for that as possible. There's obviously some risks out there. There's continuing geopolitical risks that can sometimes cause, abnormal spikes in the energy markets, which can kind of throw wrenches into the market. And of course, we still aren't sure if that rapid rise in interest rates that the Fed has orchestrated over this year, if companies are going to survive that rapid rise without really having too many problems. And as we've been talking about, commercial real estate is one of those areas that seems like it's under a lot of pressure because of that interest rate increase. So bottom line is, as great as this year has been, let's beware. Let's not be too optimistic, right? That's why a lot of times we're looking at lower beta, higher quality stocks. What does low beta mean? Well, low beta means that we try and look at stocks that aren't going to be as volatile on average as the overall market, right? Tech stocks are high beta stocks. Tech stocks are more volatile than the market on average. We are looking more at a lot of stocks that we think are lower, less volatile than the market. That's what we're favoring right now. Again, maybe looking at some of those things that are a bit cheaper and getting rid of or selling off some of those things that are more expensive. I talked a lot about bonds today. We do think that it's important to make sure that clients are well diversified and taking advantage of the fact that bonds are offering attractive returns with certainly a much more attractive risk profile than stocks. And of course, we are also making sure that we're looking at some stocks that are more defensive. And by defensive, I mean sectors like healthcare. Why is healthcare defensive? Because it doesn't matter what the economy is doing. You still need to go to the doctor. Healthcare stocks tend to be defensive, and healthcare, because value was out of favor this year, has been beaten up. So we're trying to look for some bargains there in that sector as well. So that's how we're looking at things. Hopefully that was informative, and I will pause there see if we have some questions.
Hey, Steve, thanks for covering everything so thoroughly. If you have questions or comments, please add them to the chat and Steve will answer them. In the meantime, there was one that came in earlier. Can you tell us a bit about what you think the markets are going to do next year?
Next year. So I will, I'm just going to take out my crystal ball here. Let me make sure I rub it really well, get a good shine on it. Okay. So one way we can talk about next year is, well, let's talk about what some of the other people are talking about. So I actually just read a research report. Goldman Sachs published their 2024 market forecast yesterday. And what did that say? It basically said Goldman expects the S&P 500, if we consider that the market, is going to return about 6% next year. Do I think that's accurate? Of course not. But it's a reasonable guess from a fairly significant institutional and bank that probably has some good insight into these things. So basically, is that going to be as good as this year? Nope. I mean, because obviously this year has been a lot better. But Goldman still sees reason to believe that the market will be positive next year. So that's nice. That being said, Goldman also doesn't think we have as much of a recession risk chance as some of the other places out there. So I do think that if we have a recession next year, well, that's probably going to cause a downdraft in the market. Maybe the market's able to recover from that during the year and still eke out a positive gain. Maybe not. But I do think we really have to pay attention to what's happening to the unemployment rate, because as I've always talked about, once the unemployment rate starts to move up, it doesn't stop. It's like a freight train. It keeps going. And when that happens, that's when you get recessionary conditions, because when people aren't working, they're not making money. When they're not making money, they're not spending. When they're not spending, companies aren't making as much money on their products they're selling to all those people, right? So, it's always impossible to predict these things, but, we're just going to be constantly looking at the indicators and paying attention to these things to make sure that if we do see reason to take evasive action, that's what we'll do. But at least for now, steady as she goes.
Perfect. Thanks for that. Well, I don't see any other questions. So thank you everyone for spending this time with us. We hope it was helpful. There will be a survey that appears at the end. So please take a couple of minutes to fill that out so that we can make sure these webinars are even more helpful in the new year. So Steve, I'll turn it back over to you to wrap up.
Thank you, Alana, and thank you all for joining us today. Please let us know if there are things you'd like to hear about. We always want to make sure that we're engaging. And until next time, have a great rest of your week.